A central bank does not buy gold because it expects a good year in the stock market. It buys gold when it is quietly preparing for a world it does not want to say out loud. Over the last few years, something unusual has been happening inside the vaults of central banks, especially among a group of nations most casual investors rarely think about until the headlines force them to. That group is BRICS. What these countries have been doing with their reserves is not just an economic footnote. It may be one of the more important slow-moving stories in the gold and silver market right now, precisely because it isn't loud, isn't sudden, and doesn't make for a dramatic evening news segment. Most investors watch gold and silver through interest rates, inflation prints, or the next Federal Reserve meeting. Those things matter, and we'll get into why later. But there's a second story running underneath all of that, one that has less to do with this month's economic data and more to do with a decades-long question about who trusts whom and what happens when that trust starts to erode. That's the real subject of this video, not hype, not prediction. A careful look at what a shift in global reserve behavior might mean for the metals so many of you hold watch or are considering for the first time. It's worth being precise about what we actually know versus what remains speculation, because this topic attracts both serious analysis and exaggerated claims, and the two get mixed together constantly online. So let's separate them. We know BRICS nations, originally Brazil, Russia, India, China, and South Africa, have expanded their membership and openly discussed reducing reliance on the US dollar for trade and reserves. We know several BRICS central banks, along with a number of other emerging market central banks, have been net buyers of gold for a sustained period. We know the framework for global trade settlement, largely dollar-based since the end of the Bretton Woods system in the early 1970s, has occasionally been challenged, tested, or debated by nations seeking more autonomy over their financial systems. What we don't know, and what nobody can honestly claim to know, is exactly how far this shift will go, how fast it will move, or whether it changes the dollar's role as the world's primary reserve currency. Anyone promising certainty on that question is selling you something, not informing you. Gold is not simply a commodity. It has a strange dual identity in the modern financial system. On one hand, it trades like any other asset, moving up and down on supply-demand, investor sentiment, and macroeconomic conditions. On the other hand, gold sits on the balance sheets of central banks as a reserve asset, alongside government bonds and foreign currency holdings. Most retail investors barely think about this second identity, yet it's arguably the more consequential one when we're talking about long-term demand. Think about what a central bank reserve actually represents. It isn't spending money. It isn't investment capital in the traditional sense. It's the financial foundation a nation holds in case of crisis, war, currency instability, or its usual trading partners suddenly becoming unreliable. Reserves are insurance. And the composition of that insurance tells you a lot about what a country's policymakers are genuinely worried about, regardless of what they say publicly. For most of the post-World War II era, the vast majority of global reserves were held in US dollars, US Treasury securities, and to a lesser extent other major currencies like the euro, the yen, and the British pound. This made sense. The US had the deepest, most liquid capital markets in the world, a stable legal system, and a currency every nation trusted for trade settlement. If you were a central banker anywhere on Earth, holding dollars was the obvious choice. Here's where the story gets more complicated. Trust in a reserve currency isn't only about economic stability. It's also about the belief that access to those reserves won't be taken away. That belief was tested in a public, consequential way a few years ago, when a major economy's dollar reserves were frozen as part of a coordinated international response to a geopolitical conflict. We won't relitigate the politics of that decision here. What matters for our discussion is the second-order effect it had on central bank thinking worldwide. If dollar reserves can be frozen under certain circumstances, then dollar reserves aren't purely an economic asset. They carry a political risk that didn't feel as real to most policymakers before that moment. Once that realization spreads among finance ministries and central banks, even nations with no direct involvement in that conflict start asking a quiet, uncomfortable question. What happens to us if we ever end up on the wrong side of a similar decision? Gold, unlike a dollar reserve held in a foreign bank, can't be frozen by another government if it's physically held within your own borders. That single structural difference is one of the more underappreciated forces behind the wave of central bank gold buying we've seen in recent years. This is where BRICS becomes genuinely relevant, not because of any single dramatic announcement, but because these are precisely the nations most likely to feel exposed to that kind of political risk. Several BRICS members have complicated, sometimes adversarial relationships with Western economic institutions. For them, diversifying away from dollar-denominated reserves and increasing gold holdings isn't an ideological statement. It's the same instinct that leads a prudent household to keep savings outside a single account at a single bank in a single currency. Now, an important distinction, because a lot of online commentary blurs fact and fiction here. There's persistent speculation about BRICS nations creating a new gold-backed currency to challenge the dollar directly. This idea circulates constantly in gold and silver investing circles, and it makes for compelling headlines. But as of the most recent, verifiable information available, no such unified BRICS currency has been formally launched, and the practical challenges of creating one are substantial. You'd need agreement among nations with very different economic structures, inflation rates, capital controls, and political systems. You'd need a mechanism for valuing that currency against gold that all participants trust. And you'd need the kind of deep, liquid capital markets that took the United States nearly a century to build around the dollar. None of that happens quickly. So what is actually happening? If not a dramatic currency replacement, less cinematic, but probably more important for long-term investors to understand. It's a gradual, incremental shift in reserve composition. Central banks, not just within BRICS, but globally, have been increasing their gold holdings as a share of total reserves for a sustained multi-year period, reversing a longer trend where gold's share of reserves had been declining for decades. This is documented in reports from institutions like the World Gold Council and in various central bank disclosures. The pace differs from year to year, but the direction has been consistent enough that it's now treated as a structural feature of the gold market, not a temporary anomaly. Why does that matter more than a single headline event? Because markets driven by sustained demand behave very differently than markets driven by short-term speculation. When central banks buy gold, they're typically not trying to time a trade. They're not looking to sell in 6 months if the price moves against them. This is patient accumulation, usually built into long-term reserve management policy. That kind of demand tends to support the gold market in a way that isn't easily disrupted by one disappointing inflation report or one hawkish comment from a central bank official. Does that mean gold's price moves gradually too? Not necessarily, and this is where it's easy to oversimplify the relationship between central bank buying and price action. Gold's price in the open market is pushed and pulled by many forces at once. Central bank demand is one input among several, alongside real interest rates, currency movements, positioning in futures markets, exchange-traded fund flows, jewelry demand from consumer markets like India and China, and broader risk sentiment. In the short term, these other forces can dominate and even move gold in the opposite direction of what central bank buying alone would suggest. In the long term, sustained demand from an entire category of buyer, one that was a net seller of gold for much of the late 20th century, is a real change in the supply and demand equation. History is useful here, not as a prediction tool, but as a way of understanding how these dynamics have played out before. In the 1990s and early 2000s, many Western central banks were net sellers of gold. The United Kingdom's decision to sell a large portion of its gold reserves in the late 1990s is a well-documented example, one often cited in hindsight as poorly timed given gold's subsequent price appreciation. Gold was viewed by many policymakers of that era as a relic of an outdated monetary system, an asset that paid no interest and seemed unnecessary in a world of floating currencies and sophisticated financial instruments. That mentality began shifting after the 2008 financial crisis, when confidence in complex financial systems took a hit, and it accelerated further after the reserve freezes we just talked about. None of this means gold always goes up. It doesn't, and there have been long stretches where it underperformed other assets badly. What it does show is that central bankers' attitudes toward gold shift over time, usually slowly, then all at once in response to specific triggering events. The question worth sitting with is whether we're currently in one of those slow accumulation phases that eventually becomes widely recognized, or whether this one has already run most of its course. Reasonable analysts disagree, so let's look at both sides honestly instead of picking whichever makes the better story. The case for continued gold demand rests on a few things. First, the underlying motivation, reducing exposure to geopolitical and currency risk hasn't gone away. If anything, tensions in various regions have stayed elevated, and there's little sign the distrust driving diversification has eased. Second, many BRICS and emerging market central banks still hold a smaller share of their reserves in gold than major Western economies do. If that gap keeps closing, there's room for continued buying over a multi-year horizon. Third, the practical alternatives to dollar reserves are limited. The euro carries its own fragmentation risks. The Chinese yuan isn't fully convertible and comes with capital controls that make it impractical as a primary reserve currency for most nations. Gold, by comparison, is universally recognized, carries no counterparty risk when held physically, and doesn't require trust in any single government's policy decisions. The case for skepticism deserves equal weight. Central bank gold buying, significant as it is, remains a relatively modest share of overall global gold demand compared to jewelry, investment funds, and industrial use. Even sustained multi-year buying from central banks can be offset by shifts in jewelry demand, particularly if prices climb high enough to suppress buying in price-sensitive markets like India. There's also a diminishing returns problem. A country that has already meaningfully raised its gold reserve percentage has less room to keep buying at the same pace without straining its overall reserve strategy, since gold, unlike bonds, pays no yield and can swing hard in price. So where does that leave a thoughtful investor? Probably somewhere in the middle, which is less exciting than either extreme, but usually closer to reality. Central bank demand looks like a genuine, sustained feature of the current gold market, not a fad. But it's one input among several, not a guarantee of continuously rising prices, and it doesn't remove the normal volatility of holding any asset. Silver gets discussed far less in this context, and it deserves real attention because silver's dynamics differ from gold's, even though the two often get lumped together in casual conversation. Silver isn't primarily a reserve asset. Central banks generally don't hold meaningful silver reserves the way they hold gold, which means de-dollarization story doesn't apply to silver the same way it applies to gold. So why bring silver in at all? Because it has its own structural story tied to industrial policy and manufacturing capacity, particularly within several BRICS nations. China and India, both founding or expanding BRICS members, are among the largest industrial consumers of silver, driven by its role in solar panel manufacturing, electronics, and other industrial applications. As these economies keep building renewable energy infrastructure and expanding electronics manufacturing, industrial silver demand has become a meaningful and growing piece of overall consumption. That creates an indirect connection between BRICS economic activity and silver demand. It's not about central bank reserves. It's about the physical materials needed to build the infrastructure these economies are investing in. Whether that translates into real price appreciation for silver depends on plenty of other factors, including mine supply growth, recycling rates, and global economic conditions generally, worth understanding as its own thread rather than assuming both metals move for the same reasons. Now for something more immediate and practical, because the background matters, but investors also want to know what professionals are watching right now and how it connects to the price action many of you follow closely. Professionals tend to watch a specific set of indicators to gauge whether gold's momentum comes primarily from central banks and structural demand or from shorter term speculative flows. One is positioning data in gold futures, which shows how heavily traders are betting on price direction at any given moment. Extremely one-sided positioning, bullish or bearish, has historically preceded periods of higher volatility since crowded trades tend to unwind sharply once sentiment shifts. Another is the flow of money into and out of gold-backed exchange-traded funds, which tends to reflect Western institutional and retail sentiment more than central bank behavior. There have been stretches in recent years where central bank buying stayed strong even as ETF flows were flat or negative, which tells you these two buyer groups don't always move together. Real interest rates remain one of the most consistently important variables in gold pricing over time. Gold pays no yield, so when investors can earn a meaningfully positive real return, meaning an interest rate that outpaces inflation, Holding non-yielding gold carries a higher opportunity cost. When real rates are low or negative, that opportunity cost shrinks, which has historically supported higher gold prices. The relationship isn't perfect or immediate, but it remains one of the more reliable macroeconomic threads connecting monetary policy to precious metals pricing. The dollar's strength or weakness against other major currencies plays a role too, since gold is priced globally in dollars. A weaker dollar generally makes gold cheaper for buyers using other currencies, which can support demand. A stronger dollar tends to do the opposite. This is where BRICS de-dollarization connects back to the dollar's own trajectory in a subtle way. If central bank diversification away from the dollar continues at scale over many years, it could gradually pressure dollar demand lower than it otherwise would be, though that effect would likely be slow and hard to isolate from the many other forces moving currency markets, including U.S. growth, interest rate differentials, and general risk sentiment. Here's a question that doesn't come up often enough in gold and silver content online. Who actually benefits from this narrative being discussed loudly and who has an interest in exaggerating or downplaying it? That matters because incentives help you filter information more critically. Some financial content genuinely benefits in terms of attention, from framing Bryce de-dollarization as an imminent, dramatic collapse of the dollar system, since that framing generates strong reactions and clicks. On the other side, some mainstream financial commentary has an incentive to downplay the trend, particularly voices tied closely to traditional dollar-denominated asset management, since a genuine long-term shift in reserve dynamics could be uncomfortable for portfolios heavily concentrated there. The most useful position for an individual investor usually sits between those two extremes. Take the underlying data seriously without swinging toward the most alarmist or the most dismissive read of it. It's also worth being honest about the difference between recognizing a real structural trend and using it to justify speculative decisions. Nothing here should be read as a suggestion that gold or silver prices are guaranteed to rise because of BRICS related reserve diversification, or that there's a specific timeline for when this might meaningfully affect prices. Precious metals carry price risk like any asset, and past patterns of central bank buying don't guarantee future price behavior. Anyone making investment decisions should weigh their own financial circumstances, time horizon, and risk tolerance, and ideally talk to a qualified financial professional rather than base decisions solely on macroeconomic narratives, however well supported those narratives might be. With that caveat in place, let's think through what reasonable scenarios might look like going forward. These are informed possibilities, not predictions. If Bryce de-dollarization continues at the gradual pace we've seen in recent years, the most likely effect on gold is continued structural support without any dramatic single catalyst. That would look less like a sudden price spike and more like a persistent floor under prices during periods of broader market weakness, since central bank buying provides demand that doesn't disappear during typical corrections. Silver, in that scenario, would likely keep being driven more by industrial demand and the broader health of manufacturing heavy BRICS economies than by anything related to reserve currency dynamics. If geopolitical tensions escalate meaningfully, whether through new conflicts, expanded sanctions, or further fracturing of the existing global trade and financial system, the pace of central bank gold accumulation could pick up, particularly among nations most exposed to potential future reserve freezes or financial isolation. That scenario would likely come with broader market volatility and increased safe haven demand generally, so gold's price action would reflect both structural buying and crisis-driven demand at once, making it hard to isolate how much of any move is specifically BRICS related versus general risk aversion. In a more skeptical scenario where global tensions ease, trust in existing financial institutions stabilizes, and the practical hurdles to reserve diversification prove tougher than expected, central bank gold buying could moderate from its recent pace. That wouldn't necessarily mean gold prices fall, since other demand factors would still be present, but it would mean one of the stronger structural narratives supporting the metal in recent years loses some of its pull. Which of these currently has the most support? Based on the consistency of central bank buying data across several consecutive years and different political and economic environments, the moderate, gradual continuation scenario looks best supported right now. Sudden, dramatic shifts in reserve currency dynamics tend to be rare precisely because the alternatives, as we covered earlier, remain genuinely limited. At the same time, the underlying motivation, distrust in the potential politicization of reserve assets, hasn't gone anywhere. So, continuity of the trend already in motion more likely than either a sharp acceleration or a sudden reversal, though real uncertainty remains, and an unexpected geopolitical event could shift this assessment quickly in either direction. One more angle worth exploring before we wrap up, and it has to do with how individual investors, particularly those of you watching from the US, Canada, the UK, and Australia, tend to relate emotionally to this kind of narrative. Understanding your own reaction here matters almost as much as understanding the data. For many Western investors, the idea of BRICS nations working to reduce dollar dependency feels personally unsettling, almost like a challenge to a system many of us grew up assuming was permanent. That reaction is worth noticing because it can distort how you interpret information. Some investors respond to that discomfort by dismissing the whole narrative as overstated, avoiding an uncomfortable possibility rather than actually evaluating it. Others swing the other way, convinced dollar collapse or a dramatic currency shift is imminent, which can lead to poor decisions driven by fear rather than analysis. The healthiest position and the least emotionally satisfying one is to hold both possibilities loosely, take the data seriously without catastrophizing it, and remember that global monetary systems have historically evolved over decades, not overnight, even during periods of real structural change. This is also a good moment to mention something experienced investors understand intuitively, but newer investors sometimes miss. Owning gold or silver as part of a diversified portfolio doesn't require believing in dramatic scenarios at all. Precious metals have historically played a role in portfolios as a diversification tool and a potential hedge against certain kinds of economic and currency risk, independent of whether any particular geopolitical narrative plays out as expected. You don't need to believe the dollar will lose its reserve currency status to see value in understanding these dynamics. You just need to recognize that global reserve behavior is shifting in measurable, documented ways, and that's one legitimate factor worth understanding as part of a broader financial education, regardless of what you decide to do with that understanding. Silver supply side deserves a moment too, because it's a big part of why some analysts see silver's setup as structurally different from gold's, independent of the BRICS conversation entirely. Silver mine supply is largely a byproduct of mining for other metals, particularly copper, lead, and zinc, so silver production doesn't respond as directly to silver's own price the way gold mining does. If silver prices rise sharply, it doesn't necessarily trigger a proportional jump in dedicated silver mining the way higher gold prices tend to encourage new gold mine development. That supply and flexibility means if industrial demand keeps growing, driven partly by renewable energy buildout across BRICS economies and elsewhere, and mine supply doesn't expand to match, the balance between supply and demand could tighten over time. That's a separate dynamic from anything related to central bank reserves worth understanding on its own terms. So let's come back to where we started. Why should this matter to you today, regardless of whether you already own precious metals, are considering them for the first time, or are just trying to understand the forces shaping global markets? The honest answer: we're watching a genuine, multi-year shift in how a meaningful share of the world's central banks think about reserve composition and currency risk. It didn't start with a single dramatic announcement, and it probably won't resolve with one either. It's unfolded gradually through consistent documented purchasing behavior, reflecting concerns about geopolitical risk and financial trust that don't look close to resolving. Whether it translates into significant, sustained price appreciation for gold and silver over the coming years depends on the interest rate policy, currency dynamics, industrial demand, and investor sentiment we've covered throughout this video, none of which can be predicted with certainty. What can be said with reasonable confidence is that this isn't a narrative built on speculation or exaggeration. It's built on observable behavior from some of the most cautious, risk-averse institutions in the global financial system, institutions that generally don't make reserve allocation decisions casually or without careful internal analysis. When that category of buyer sustains a multi-year pattern of behavior, it's worth paying attention to, even without any guarantee about what it means for your own portfolio. If there's one idea worth carrying with you After this video ends, some of the most important decisions shaping the gold and silver markets right now aren't being made by retail traders reacting to daily headlines. They're being made quietly over years by institutions whose entire purpose is managing risk on behalf of entire nations. Paying attention to what they're doing rather than only what they're saying tends to be one of the more reliable ways to understand where genuine demand is actually coming from. So here's a question worth sitting with. If central banks around the world are increasingly treating gold as financial insurance against political and currency risk, what does that suggest about how you think about insurance within your own portfolio? Is that a conversation you're currently having with yourself or one you've been avoiding? If this kind of grounded look at the gold and silver market was useful to you, a like helps this content reach more people trying to think clearly about these markets instead of reacting emotionally to them. If you want more analysis like this, subscribing means you won't miss the next breakdown of what's actually moving these markets beneath the headlines. And if you're curious how real interest rates specifically shape precious metals pricing, there's another video that walks through that relationship in detail, and it's a natural next step from everything we've covered here today.